Hello everyone and thank you for watching Edupedia World videos. I'll be your teacher for tax planning and management, and today we'll start the subject from chapter 1, that is basic concepts. And in that we'll start with the introduction to this subject, a very basic introduction to the subject of tax planning and management. So let us start this subject. First of all, we need to know the learning objectives for today's class. What are the learning objectives for today's session? Number 1, meaning of tax. What does taxation exactly means? We'll learn that. Secondly, the various types of taxes. The taxes levied by the government upon the citizens of our country. What are they? Number 3, levy of taxes. How are taxes levied and what activity a person does that make him liable for the taxes. And number 4, components of income tax law. What are the different components of the income tax law? What does the income tax law in our country consist of? And also we'll learn about the concept of income. What exactly income means. So in today's class we'll just go through all these topics, and at the end of the class we will able to understand all these topics, that is the meaning, the types, levy, components, and the concept of income. What is tax? Tax is a fee charged by a government on a product, income, or activity. So the basic definition of tax is given as a fee charged by the government. So if I am producing some product, manufacturing some product, I have to pay tax, which is called excise duty. So a manufacturer has to pay tax in the form of excise duty. And if I am earning some income, I have to pay tax in the form of income tax. And if I am providing some services to someone, then I have to pay tax in the form of service tax. So whatever activity I am engaged in, either I am manufacturing or earning income or providing some activity or services, then I am liable to pay tax. There are two types of taxes, direct taxes and indirect taxes. If taxes are levied directly on the income or wealth of a person, then it is a direct tax. For example, income tax. So income tax is a direct tax because it is levied directly on the income which is earned by me, and I am only liable to pay the tax on my income. And indirect tax is tax levied on the prices of a goods or services. So if I am producing some product, I am manufacturing some product, excise duty is levied upon it. But I am not liable to pay that excise duty. Rather, the person to whom I will just sell those goods, they will be liable to pay that excise duty. Similarly, services. If I am providing some services to someone, I'll not be liable to pay that service tax. Rather, the person who is getting those services, I'll collect the service tax from them and then deposit it to the government. So these are the forms of indirect tax. And in the same way, sales tax and VAT. If we are just purchasing some goods from somewhere, then we have to pay sales tax on it. So the person who is selling the goods, he is not liable to pay the sales tax. Rather, he'll collect the sales tax from us and then deposit it to the government. So these are the types of indirect taxes. The major difference between direct tax and indirect tax is that in direct tax, the tax is levied directly on my income and I am only liable to pay that. And in case of indirect tax, the taxes are levied on the goods and services, and the person to whom those goods are sold or the services are rendered, from them the taxes are collected and then paid to the government. So this is the difference, major difference between direct tax and indirect tax. Indirect tax, the burden of the taxation falls upon the consumers, and in direct tax, the burden is on the person on whom it is levied. Now we come to the types of taxes in detail. In the previous slide, we discussed about the two major types of taxes, that is direct taxes and indirect taxes. These are the major subdivisions in the types of taxes. Now we'll further study the subdivisions of these major divisions. In direct taxes, there are mainly two types of taxes, that is income tax and wealth tax. Income tax is levied upon the income earned in a year by a person. The government levies income tax on that. And Another form of direct tax is wealth tax. This is a very uncommon form of tax in our country. It's not a widely paid tax. It's very uncommon type of tax in our country. The major type of tax or the common type of tax, direct tax that is prevalent in our country is the income tax only. In the wealth tax, the tax is levied, a very small percentage of tax is levied upon the wealth of a person. We'll discuss about all these things in detail as we proceed, but for now on we need to know that income tax and wealth tax fall under the category of direct taxes. And in the category of indirect taxes, we have excise duty, custom duty, service tax, and sales tax. Excise duty, as we discussed in the previous slide, is the duty levied on manufacture. So, if a person is manufacturing goods, he is liable to pay excise duty on that manufacture of product. In custom duty, we have that whenever we are importing goods from another country or exporting goods outside our country, so we are liable to pay custom duty. Custom duty is basically related to import and export. In service tax, as we discussed, that whenever I am rendering some services to any person, I am liable to pay service tax, sales tax, and VAT. Very common type of tax. We all are aware of, we all know so widely used term sales tax and VAT. So this is a indirect tax which is levied on products, price of the products that are sold. So these four are the types of indirect taxes, that is the excise duty, custom duty, service tax, and sales tax. All these are indirect tax, that is the burden of taxation falls upon the consumer. The manufacturer collects it from the consumer, the service provider collects it from the consumer, and the seller collects it from the consumer and then deposits it to the government. Now come the reason for levying taxes. Why are taxes levied? The major reason of levying taxes by the government is that they form the basic source of revenue to the government. Until and unless the government collects revenue in the form of taxes from its citizens, how the government will run the economy, how the government will meet its expenses. The government has to expend so much for the economy, so they need some source of revenue. And taxes are the basic source of revenue to the government. So this is the major reason, in fact, the only reason that the government levies taxes on its citizens so that they can meet the various expenditure for the economy. The various things in which the government need to expend are defense, provision of education, healthcare, infrastructure facilities like roads, dams, etc., and many more. The government have so many expenses to meet. So they just collect revenue from the citizens in the form of taxes and just give back to them in the form of defense, provision of education, healthcare, etc. So this is the main reason why government levies taxes and collect taxes from its citizens, so that the government can help the citizens with the betterment of the economy, with the development of the economy, with the better infrastructure facilities, better healthcare, better education for the citizens. The components of the income tax law. In this slide, we'll just get to know about the various components that the income tax law consists of. The income tax law in India consists of the following components. They are the Income Tax Act, the Annual Finance Acts, the income tax rules, circulars and notifications, and legal decisions of the courts. So, these are the 5 components of the income tax law in India. The government imposes the income tax on its citizens by following the rules, provisions, notifications given in these components. These components together form the basis for the income tax law. We'll discuss each of the components in detail in the coming slides. The Income Tax Act 1961. This is the first component of the income tax law. The Income Tax Act was enforced in our country on 1st April 1962. The levy of income tax in India is governed majorly by this act. This act forms the basis for the levy of income tax on the income of the citizens of our country. The act contains 298 sections and 14 schedules. So it's a very wide and very big act containing lots and lots of provisions for the taxation of income in our country. It does not leave any scope for any income, like each and every type of income is covered under this act, and it has made almost every income taxable. These undergo change every year with additions and deletions brought about by the Annual Finance Act passed by the Parliament. So, this is a very old act, like 1961 it was enacted. So, it has to undergo changes every year so that it matches up to the current scenario, and all the new provisions are just added and all the obsolete and old provisions are deleted regularly from this act so that it matches up to the current scenario and it is at par with the current economic situations. In pursuance of the power given by the Income Tax Act 1961, rules have been framed to facilitate proper administration of the Income Tax Act 1961. As we studied in the previous slide, that there is one component named as income tax rules. So this act has given power to the CBDT, that is the Central Board of Direct Taxes, that is the major taxation body in our country that administer taxes. So they form income tax rules so that the income tax is better administered and better collected. It's collected in a proper and efficient way, and the government is able to collect more and more income tax, and the revenue of the government is increased manifold. So this is the first component and the major component of the income tax law, that is the Income Tax Act 1961. The whole study of this subject will revolve around this act only. Second comes the Finance Act, that is the Annual Finance Act enacted in our country so that the Income Tax Act is updated. Every year, the Finance Minister of the Government of India introduces the Finance Bill in the Parliament's budget session. As we all know that just now only the Honorable Finance Minister of our country, Mr. Arun Jaitley, introduced the Finance Bill. The Finance Bill for this year was introduced in the Parliament, and we all are aware of it. So that is the way in which the Income Tax Act is updated. The government, the Finance Minister of the government, introduces the Finance Bill in the Parliament, and that becomes the Finance Act after it has been passed by both the houses and it gets the assent of the President. It becomes the Finance Act, and that act acts as an updation to the Income Tax Act. The various deletions and additions are made to the Income Tax Act 1961 through this Annual Finance Act. Amendments are made every year to the Income Tax Act 1961 and other tax laws by the Finance Act. In the Income Tax Act, amendments are made by this act. In other taxes like the service tax, excise, custom, all these types of indirect taxes, these are also updated and amended by the Annual Finance Act so that these acts remain updated and are upgraded every year, and they are at par with the current economic scenarios. So additions and deletions are made by the Finance Minister through the Finance Act. So this is also a very major part of the Income Tax Act, because until and unless the acts are updated, they do not hold any relevance. So in order to make them relevant and more practical, the acts are updated through this Finance Act. Now comes the income tax rules. This is the third component of the income tax law. As we discussed in the previous slide, that The Income Tax Act 1961 empowers the CBDT to make some rules in order to administer the collection for the better administration of the collection of the direct taxes. So, for the better administration, the CBDT forms some rules known as the income tax rules. So, let us read the points one by one. The administration of direct taxes is looked after by the Central Board of Direct Taxes. The CBDT is empowered to make rules for carrying out the purposes of the Act. As we discussed that some of the provisions of the Act are tricky, which we are not able to just decipher. So the CBDT just makes these rules for the proper interpretation of the provisions of the Act. For the proper administration of the Income Tax Act 1961, the CBDT frames rules from time to time, same as we discussed. These rules are collectively called the Income Tax Rules 1962. So, this is the definition of the income tax rules. What are they, how they are formed, and who forms them, and for what purpose. Next comes the circulars and the notifications. First of all, we'll go through what are circulars. Circulars are issued by the CBDT from time to time to deal with certain specific problems and to clarify the doubts regarding the scope and meaning of the provisions. So, sometimes it happens that the provisions contained in the Act are confusing and it creates two thoughts in the mind of the interpreters. So, in order to clarify that and in order to just establish the proper meaning of the provisions, the CBDT issues circulars so that the officers and assessees does not misinterpret the provisions. These circulars are issued for the guidance of the officers and assessees. The department is bound by the circulars, meaning that the department has to follow whatever is given in the circulars, whereas the assessees are not bound by the circulars. The assessees can just take advantage of the beneficial circulars. If they find that the circulars are benefiting them, they can take their advantage and follow the circulars. But sometimes it happens that the circulars are against the assessees, meaning that it is not that beneficial to the assessees. So the assessees can ignore the circulars and just interpret the provisions in their own benefited way, and the circulars are not binding on them. So this is an interesting thing about the circulars, that the department has to follow the circulars while the assessees can take advantage of the beneficial circulars, whereas letting go the non-beneficial circulars. Next comes the notifications. The notifications are issued by the central government to give effect to the provisions of the Act. All these circulars and notifications are supplementary to the Act. The provisions contained in the Act, they are sometimes not that much easy to interpret. So these rules, circulars and notifications, they are helpful in the proper interpretation of the provisions so that we can take the advantage of the provisions rather than being misguided by the provisions. So, the CBDT issues the circulars and the central government issues the notifications for the proper administration of the Act and to give effect to the provisions of the Act. The CBDT is also empowered to make and amend rules for the purpose of the Act by issue of notifications. So, the central government issues notifications for the proper administration of the Act, and the CBDT issues notifications to amend the rules, the income tax rules that we discussed in the previous slide, that can be amended by the issue of notifications. So, the notifications can be issued by the central government also and the CBDT also. The central government issues it to give the effect, proper effect to the provisions of the Act so that the provisions are properly implemented, and the CBDT issues notifications to amend the income tax rules, which ultimately is for the proper implementation of the Act. So, circulars, notifications, income tax rules, everything is there for the proper implementation of the provisions of the Income Tax Act. The fifth And the last component of the income tax law are the case laws. What are they? So, let's first read the point and then I'll make you understand what does that mean. It is not possible for the Parliament to conceive and provide for all possible issues that may arise in the implementation of any act. Hence, the judiciary will hear the disputes between the assessees and the department and give decisions on various issues. What happens is that the finance minister and the government just tries to figure out all the possible issues which are there currently in the economy, and they try to just insert it in the annual finance act, which ultimately gets implemented in the income tax act. So they just try to conceive and provide for all possible issues that are there and that are unsolved, and for that they provide the solution in the form of provisions in the act. Whatever issues are cropping up in the economy, they just provide some solution to that in the form of new provisions and new additions in the act. But sometimes it happens that they are not able to just conceive and provide solutions for all the issues. Obviously, it's not practical that anyone can just conceive and provide for all the possible issues that may arise. So what happens is that when some issues are left unanswered, that just creates problem between the assessee and the department. So the judiciary come into play then. The judiciary hear the disputes between the assessee and the department, whatever disputes and whatever issues have cropped up which have been not answered by the parliament and by the finance minister in the annual finance act. So those issues are heard by the judiciary. The judiciary hear them, hear everything, all the statements and all the everything given by the assessees and the department, whatever they are presenting to the judiciary will hear everything properly and then give decisions on those issues. So then those issues which are solved by the judiciary, they become the case laws. And whenever the same issue creeps up in future, these case laws help in solving those issues. So if there are no provisions in the act regarding some issue, the case laws help in solving them. Now comes the next topic, levy of income tax. On whom does the income tax is levied? Income tax is levied on the total income of the previous year of every person. So, who all are included in this word person? A person includes an individual like you and me, Hindu undivided family. Now, this is also one form of entity which we'll discuss later on. All these association of persons, body of individuals, all these are types of entities on whom the income tax is levied. A firm like a partnership firm, company that is private company, public company, etc. All these entities are liable to pay income tax on the total income earned by them. The Income Tax Act has divided the category of persons into individuals, HUF, AOP, BOI, firm, company, and they have just given provisions in the Income Tax Act that how the individual will be taxed, how HUF will be taxed, and so on. All these entities are taxed on a different basis and differently. All these have different provisions in the Income Tax Act. Like an individual is not taxed in the same way as the HUF is, or the firm is not taxed in the same way as a company is. Every entity is taxed in a different way, and the act contains different provisions for different entities, which we'll discuss in the coming classes about how an individual is taxed, what are the provisions contained in the Income Tax Act regarding the taxation of individual, regarding the taxation of HUF, and so on. Now comes the concept of income. What does income means? This is a very important part of the Income Tax Act. because until and unless we understand what things are included in the definition of income, we cannot proceed further. That, like, we have to know what exactly income means. Until and unless we know what is income, how we'll tax it. So this forms a very important part of the Income Tax Act, the concept of income. So let us now read and understand each point one by one. The definition of income as per the Income Tax Act 1961 begins with the words income includes. So this is a very notable point that the definition starts with the word income includes. What does that mean? It means that the definition is an inclusive definition and not an exhaustive one. Inclusive means the definition is given that okay, all these things are included in income, and it says that apart from all these things given, there may be some other things which can be included in this definition. So we are saying that it is not an exhaustive one, meaning that it's not that all these things only will form income. There may be some other income which can be called as income. So this definition is an inclusive one, meaning some more things also can be included in it, regarded it follows certain principles. Like, we'll discuss it now after this point, that what are the principles relating to income. So if anything else which are just following these principles, those things will become an income. So the definition is an inclusive one. Whatever follows the basic principles relating to income, all these things will be included as income. What are those principles? Number one, income in general means a periodic monetary return which accrues or is expected to accrue regularly from definite source. So, if I am earning any income which is periodic, which is accruing to me regularly and which is coming from definite source, then I have to include that income. That is an includable income. But one thing is to be noted, that in Income Tax Act, if some income is not periodic in nature also, then also it has been brought under the purview of income. So before starting the taxation part, I would like all of you to know that an Income Tax Act is more upon the exceptions rather than the general principles. So you all have to be aware of the exceptions. Like here it's given that whatever is periodic in nature and expecting to accrue regularly from definite sources income. But one exception is given, that if I am earning something which is not regular also and not periodic also, then also it will be included in my income. For example, if I am winning from lottery or crossword puzzles or horse race, etc., all these will also be included in my income. So this we have to just take very special care of, that the Income Tax Act contains many provisions which have numerous exceptions. If one provision is given, there will be lots of exception to that provision. So we have to just take care of all these things. Be aware of it from now on only, that Income Tax Act will contain many provisions and those many provisions will contain many exceptions. Now the second principle relating to income. Income normally refers to revenue receipts. Capital receipts are generally not included within the scope of income. So now here also just note the word generally, that income normally refers to revenue receipts and capital receipts are generally not included, meaning that there is exception to this point also, that the Income Tax Act has brought within its purview the capital receipts also. For example, if we sell some land or jewelry or whatever capital assets I am possessing and I am earning something, then that income will also be taxed. So, in general, capital receipts are not included, but the Income Tax Act contains exception to this and it has made the capital receipts taxable under the head capital gains. Third, income means net receipts and not gross receipts, meaning that if I am earning something, So that will be taxed only after deducting the expenditure which I have incurred in earning those receipts. So net receipts come after deducting the expenses incurred in earning those receipts. So income will form part only the net receipts and not the gross receipts. Income is taxable either on due basis or receipt basis. This is also an important part. If I am a businessman and I am carrying on any business and I am maintaining my accounts on due basis, so my income will be taxable on due basis. If I am maintaining my account on receipt basis or cash basis, my income will be taxable on cash basis. Last, income earned in a previous year is chargeable to tax in the assessment year. This is a very important provision of the Income Tax Act, that if I am earning any income in this year, I have to pay tax on that income in the next year. So this year will be my previous year and the next year in which I'll pay tax will be my assessment year. For example, I am earning any income in a previous year 14-15, so I have to pay tax on that income in the assessment year 15-16. This is a very important provision. Please just remember this because this has so much relevance in the coming classes. So we come to the end of today's class. In today's class, we just learned what is tax, what are the types of taxes, how taxes are levied, on whom taxes are levied, why taxes are levied, the concept of income, the very important concept, the principles relating to income, what principles are there for which have to be there in order to include income under the Income Tax Act. So all these things we just understood in this class. I hope you all just understood the concepts which I discussed in today's class, and the next class we will just proceed with total income, the taxation of income, and so on. Thank you, students. I hope you found today's class helpful and worthy.